This marks one of Hong Kong's largest commercial real estate deals in recent years, but also comes amid a commercial property glut. Talk to us a little bit about doing this deal at a time like this.
Sure. Well, firstly, this was not an opportunistic deal. This was a strategic deal. We've had a great relationship with the Exchange for 40 years. The reason why it's called the Exchange Square is because of the Hong Kong Exchange. So for their decision to have a permanent residency in our Exchange Square for forever, extending our partnership forever, is just a great strategic opportunity for us, because it really does cement Hong Kong Central as the centre of finance, commerce, lifestyle. We announced quite a large initiative last year where we're spending $1 billion on the upgrade of our landmark mall, along with our luxury retail partners. Our sister company, Mandarin, last week announced the $100 million refurbishment of Mandarin. So I think the whole central complex, we're spending $50 million of the proceeds to really elevate Exchange Square and to make it a real iconic experience for the customers of Hong Kong Stock Exchange. There'll be signage around the top of One Exchange Square, Hong Kong Stock Exchange signage. It's really going to change the whole sort of makeup and cosmetics of Hong Kong Central and really elevate it, which is our intention. And it really does show a lot of commitment and confidence in the future of Hong Kong.
Hong Kong Exchange is going to be taking over the space next month, and there's going to be some renovations of the retail space over the next 3 years. How come you guys are paying into that as well?
Well, it's partly self-serving. I mean, we get to upgrade. The asset is over 40 years old, so we built the Exchange Square quite a few years ago, so it does need some capex work. But we're very much focused on elevating the experience for the Exchange, really making it a lot more public interface, a real immersive experience, really befitting, one of the world's largest financial exchanges in the world. So part of that is to ensure that the Exchange has a permanent location that they're really proud of, that Hong Kong's really proud of. So putting capital back into that project is really important to us.
A couple months back, the company Hongkong Land announced a strategic pivot, an asset reshuffle, if you will, looking to raise $10 billion from the portfolio in a recycling. How is that going?
It's going really well. We made one of the principal decisions was to exit the build-to-sell business. So that's a conventional development business where you buy a piece of land, you build a condo, and then you sell those condos to third parties. So we made that decision to no longer invest in that business, but to focus on what we're really good at, which is projects like Hong Kong Central, like what we've done in Singapore and Marina Bay, what we're doing in Shanghai and the West Bund. So the decision to stop that means that a lot of that inventory, once it's sold, will come back to the business. Most residential development businesses, when you sell a project, you go buy more land. So that decision not to buy more land means there's quite a lot of capital. So sort of 60% of that $10 billion or thereabouts will come back to us by making that decision no longer to participate. But in addition to that, there are transactions such as this, which are very strategic, which makes a lot of sense to us because from a valuation perspective, one of the issues about Asian property companies, including ourselves, is that we trade at very big discounts to our intrinsic sort of net asset value. So if you value all of our assets, take away the mortgage debt, what's left over is the equity in the real estate, the net asset value. So at the moment, we trade at $13.57 as at the end of last year. That is our NAV. So independent values of our assets, $13.57, yet last night we closed at $4.23. So a 70% discount between the intrinsic real estate value and our share price. So this transaction, I think, goes a long way in making sure that people do believe what the NAV is. I think there's a lot of disbelief around the independent values and is real estate really worth what the valuers say it's worth? I think this transaction really helps demystify that because we, after many months of negotiating, willing buyer, willing seller, arm's length, we agreed on a price which reflects the independent valuation of last year. So effectively that $13.57 is what we agreed a price at. So we're going to use $200 million of those proceeds to now buy back the shares at $4.23. So we're basically selling at $13.57 and buying back at $4.23. And if we did that enough, that really should help close the gap, that 70% discount, and create shareholder value. So that's also part of, from our perspective, if people don't believe the value of our assets, they should have much more belief now.
The share buybacks, $200 million, is there expectations that you can continue to add to that?
Yes, so when we announced in October, we made some very bold statements, doubling our earnings, doubling our dividends. One of the statements was that we would recycle $10 billion of our capital, and up to 20% of that we would be using to fund buybacks, depending on pricing and market conditions. But while there's a 70% gap, it makes a lot of sense for us to buy back. So basically sell an asset, use 20% of those proceeds to then undertake a share buyback. So the more that we continue our recycling program, the more shares that we'll buy back.
I want to talk about the trade war and the tariff impact. Not a day that goes by that we are trying to decipher and navigate through the fluid situation. Now, the Hong Kong office market has been a little bit sluggish. Talk to us about the impact from the trade war on your portfolio.
Look, I think directly it has less impact on us than others. We're not a supplier of products or widgets. We build and invest in hard real estate. All of our real estate is in Asia, so principally Hong Kong, Singapore and China. But we do suffer from the sentiment that gets impacted by the sort of market volatility that we've experienced the last couple of weeks. It makes it a lot harder for an occupier to make a long-term decision on a lease or what type of space requirements they make. So yeah, we have those sort of macro impacts, but no direct impacts on us in terms of tariffs.
Now, in terms of that sentiment and going back to the $1 billion investments that you guys will be making in terms of refurbishing and making the 10 Maison destinations, you've got 12 interconnected buildings across the Central, and you're going to be making huge investments together with your retail clients. Has there been any hesitation given what's all going on in the world? Talks about global recession, the confidence in the market.
I think we've been quite fortunate. Many of those negotiations were done quite a few years ago. They weren't done now, so we've already started that process. 2 of our big Maisons will open this year. Sotheby's already opened. Prada and Saint Laurent will open this year. 3 more next year, 2 the year after. So they're quite a long way into their program. I think they also benefit from the fact that Landmark has been around for many, many years. It really is an icon in Hong Kong. Chanel opened their first store in Asia in 1973, so they've been there for more than 50 years. So I think there's a real comfort with that is the centre of luxury. We're not reliant on mainland tourists. 85% of our customers are Hong Kong. Hong Kong is a very large centre of high net worth, and Landmark is a recipient of that. So that gave the confidence for the brands to deploy capital alongside us to create iconic stores. And then, you know, we'll have an 8-story Hermès, an 8-story. I mean, it's going to be pretty amazing when that complex is finished. In addition to the Mandarin, in addition to work we're doing with the government to elevate some of the streetscapes of Central, what we're doing to Exchange Square, I think when we all look back in 28 or 29, Hong Kong Central will be a much different, much more vibrant, much more exciting place.
Talk to us about the commercial property market. The office market has been sluggish. There are record high vacancy rates, and an additional 3 million square feet of new space is going to be coming online next year. We have, of course, the Henderson, which is new, Cheung Kong Center 2, and then there's another Henderson building that is currently being built underway at the Victoria Harbour front. How is the health and the state of the Hong Kong office market?
Look, absolutely there are headwinds, there's no doubt. We do benefit from the ecosystem. We bought our first piece of land in 1889 in Hong Kong Central. So it's 135 years, 136 years of war and peace and famine and feast and ups and downs, and we've managed to control that estate. The 12 office buildings, the 2 Mandarin Orientals, the Landmark Mall, the bridges that interconnect, that ecosystem is quite unique. And it's really unique in a finance centre anywhere in the world. So as a consequence of that, we get a lot of flight to quality. We get a lot of tenants who want to be part of that ecosystem. So the more that we're doing in terms of our Landmark refurbishment, Mandarin's refurbishment, what we're doing in Exchange Square, I think the more that people will be attracted to that ecosystem and want to be there. So as evidence right now, our vacancy is about half of the Central vacancy. So I think, you know, Henderson is leasing up very well right now, which is great. But our portfolio through cycles tends to be a lot more resilient because of the ecosystem we create, which also explains the strategic move we did last year. Was that's what we want to do going forward. We're doing that in Shanghai with West Bund, which is one of the biggest projects in China at the moment, if not the world outside of Saudi Arabia. Marina Bay in Singapore, we've been there for many years in that office market. So those are sort of integrated complexes. That's where we think people want to live, work and play, and that's what we want as the focus of our business, maybe in Tokyo, maybe in Seoul, maybe in Sydney over time. So these type of capital recyclings like we just announced helps build the war chest to enable us to take those opportunities as they present themselves. I
want to dig in a little bit more. Physical vacancies at 7.3%, and there's also falling rent. Hong Kong dollar, $101 per square foot, the average office rent in your portfolio. Can you give us an outlook?
Look, I think this year there may still be a slight contraction in market rents, but nowhere as steep as it's been. I mean, Hong Kong has gone through the last 6 or 7 years of falling rents. I think from the last peak, market rents are down 30-40% since the peak. But people who have a longer memory of Hong Kong, the market rents can be pretty cyclical and pretty volatile. So I think when the existing supply in Central lets up, particularly the Henderson Port piece, which is a great property, that will augur very well for us. If there is a change of sentiment, the capital markets for us is really important, which is why the exchange committing to our building is really important, because we are very much driven by capital markets activity. We have 450 office tenants, 73 law firms, 2 of the big accounting firms. If capital markets is active in Hong Kong, which it has been, and it looks as though the forward in terms of IPOs, etc., look pretty attractive, Hong Kong finance and commerce tends to be pretty interesting as well, and therefore the demand for space. And our portfolio really is the portfolio of choice if you want to be part of that ecosystem. So it is a tough headwind. I think it's probably neared the bottom or going up, but when it does move up, as it has in other cycles, rents can move up pretty quickly.